Hello and welcome to the Genuine Learning blog. My name is Melissa Galasso and I'm excited to be here today to talk about a new proposed standard related to our SARS standard. So as part of this overall process, obviously there has been lots going on in the area of a review. We had the omnibus come out, which is effective this year, and now they have a couple of additional items that they are trying to address specifically for SARS. The first one is the concept of materiality in a review of the financial statements, the concept of an adverse conclusion, and addressing some issues for special purpose frameworks. So lots in here, so let's dive on in. So this was issued on June 19th of 2019, and comments are due September 20th, 2019. And as I said, the concept here is really there's two elements. We, as much as possible, want to make sure our language is consistent between the SASes and the SARS, right? So to the extent that we are using one body of knowledge for performing under the AICPA, to the extent that they can, they're trying to. However, they also are really trying to converge with the international standards. And so both of those are really driving the forward progress that the ARSC is making. So ARC Section 60 adds terms like financial reporting framework, designated accounting setter, general purpose framework, general purpose financial statements, special purpose framework, and special purpose financial statements consistent with the SASes. So again, as part of this overall process, ARC section, which are just the general principles, are going to have some new language. In addition, it also updates the definition of financial statements to be consistent with the audit standards, so kind of bringing things together. You'll also notice some movement between standards. Sometimes things were defined later in SARS and they got also moved up to the definition. So some things might have just moved around in terms of location. For ARC Section 70, which is our prep engagements, here we're really looking at the concept about withdrawal. So in this scenario, they're going to, again, be very similar to ARC Section 80 when we are having a withdrawal for a compilation agreement or compilation engagement. This is very similar. It's going to propose requiring the accountant to inform management of its reasons for withdrawing from the engagement because the accountant's unable to include the no assurances provided, or management fails to provide additional or corrected information. So those are going to be some additional requirements in terms of our withdrawal information. ARC Section 80 adds guidance on and this is for our compilation engagements, for when we're using a contractual basis of accounting as a special purpose framework. Now, where we're going to see most of the items addressed in the standard is ARC Section 90, which is the review of financial statements. Some pretty significant changes here. So the most of these are converging with the AICPA, which also have been revised recently. So first off, they do give us a definition of limited assurance. They did take a lot of what was changing in AICPAs. However, they have some language that we chose not to include. So they talk about a meaningful level of assurance, and the AICPA's ARSC was not quite on board with that. So there are differences in this definition with AICPAs, but it is more closely aligning. So we would want to make sure that we understood in a U.S. version. So it's the level of assurance obtained at which the risk the accountant expresses an inappropriate conclusion is greater than it is in an audit engagement, but it is an acceptably low level in the circumstances of the engagement as a basis for expressing a conclusion, right? So we don't express an opinion in a review, we express a conclusion. So we're going to accept additional risk, however, it's acceptable because of the intent. In terms of the application guidance, they do talk about sufficient appropriate evidence. Having just talked about audit evidence on the audit side, I thought this was pretty interesting because they do talk about what is sufficient appropriate. Again, we're giving a conclusion here. So they do talk about it being cumulative in nature and primarily obtained during the course of the review. However, they do tell us that the nature, time, and extent is limited compared to an audit. So we think review, we typically think inquiry and analytics. However, we do have to have sufficient evidence as part of this. So when we think about review evidence, as we said earlier, this is what's underlying the financial statements. We do analytics and inquiries. The definition here, though, is sufficiency is a measure of quantity, which is what the AICPA's Auditing Standards Board is moving away from. They're talking about persuasiveness, but again, there are differences between performing a review, which is only expressing limited assurance, versus an audit, which is expressing a higher level of assurance, reasonable assurance. And then appropriateness is a measure of the quality, relevance, and reliability. So obviously the AICPA committees do talk to one another, and so they're able to leverage that. They do have staff liaisons that are able to talk to one another, and you can see that in some of these standards. They also add a definition of professional skepticism. Traditionally, ARC Section 90 has not included an explicit requirement to plan and perform in accordance with professional skepticism, so they do add that here, an attitude that includes a questioning mind, being alert to conditions that may indicate possible misstatement, and a critical assessment of review evidence. So you can see here that they are bringing some things more in alignment. One area that's getting a lot of attention from this standard is materiality. Technically, extant ARC Section 90 does not include an explicit requirement to determine materiality. In fact, if you look at some of the third-party providers, they do not provide a calculation form for materiality. And as such, we find many firms actually use the audit calculation of materiality here. And so that has always been one of those areas that was very interesting, because we say that the conclusion is there's no need for material modification, but we didn't actually require the calculation of materiality. And so when we're thinking about that limited assurance concept here, and are we aware of any material modifications that should be made, how do you do that without actually calculating materiality? And so they are proposing an explicit requirement to determine materiality for the financial statements as a whole and apply that when performing procedures. So that would be a material difference from what we do today. No pun intended. They also do add some additional inquiries as part of this process. So inquire of management who have responsibility for financial and accounting matters about material commitments, contractual obligations and contingencies, and material non-monetary transactions. So again, just some additional items as part of those overall inquiries. They also have additional inquiries related to related party. They have some additional requirements during the review to remain alert for indications of related parties that were not previously identified. And then if they do identify significant transactions outside the normal course of business, they should inquire about the nature and whether there were any related parties involved. Another major swing in what's going on today is going to be in the area of an adverse conclusion. Today, you cannot say that the financial statements require material modification. You cannot say that they're materially misstated. And so currently there's a prohibition in ARC Section 90 on modifying it to include a statement that financial statements are not in accordance with the framework, right? Giving an adverse conclusion. And people were questioning whether that was appropriate. Today they do have guidance on known departures, but you could not make an explicit statement regarding that it was materially misstated. And the ICERs now have now permit the concept of an adverse conclusion. So AICPA is taking a look at that. So it's the ability for the accountant to express an adverse conclusion when he or she determines or is otherwise aware that the financial statements are materially misstated and the effect of the matter or matters are material and pervasive to the financial statements. And their definition of pervasive is a term used in the context of misstatement to describe the effects of the financial statement of misstatements. It is a judgment. They are not confined to a particular element, account, or item. And if so confined, represents or could represent a substantial portion, or with regard to disclosures are fundamental to the user's understanding. So they do give us this updated definition. We do know that the attestation standards are also looking at this as a potential opportunity in their review engagements, which are potentially getting updated there to permit an adverse conclusion. So it would actually mirror the two. If you had inconsistent information, there would now be a requirement to document that information that has been identified and then how the inconsistency was addressed. So if you come across something that is inconsistent with your other information, how did you address that in the context of the review? And then finally, another area that's getting some attention is in the area of consistency. So AU Section 708 in an audit is on consistency of the financial statement, and it requires an emphasis of matter paragraph when there are adjustments to a material, to correct a material misstatement. And so in this next area, they're going to, ARSC is discussing whether to include reporting requirements when there are adjustments to correct a material misstatement in previously issued statements. However, they did not come to a conclusion and are actually asking for feedback about whether we think that would be in the public interest. Should we think about aligning with AUC Section 708? They haven't made a decision, so this is sort of up to us as to provide feedback whether we think that would be helpful or not. In terms of when would this be effective, they're saying periods ending on or after June 15, 2021, giving us some time to get ready for this. Obviously, it would require some changes in processes as well as probably QC area. Early implementation, however, would be permitted, and I was actually kind of surprised by that. So that was something that kind of caught my attention. So that is it for today's Genuine Learning blog. I hope you found it useful, and I hope to see you on a future blog. Have a great day, guys. Bye-bye.